Good morning, everyone. So, your any doubts, any questions, dear? Okay. So I discussed with you I was discussing with you the foreign exchange rate system, and just let me on your WhatsApp chat. हाँ वो रख दो. Yes, good morning. So any issue or any doubt related to earlier topics, dear? No. Okay. Fine. Now, I think you have seen that in foreign exchange, I'm just giving you 2 minutes the review of this. I started your external sector and topic what we started in external sector, the foreign exchange rate first. Why I'm just discussing it? Because now you can connect these things with the current things, what is going to happen in the country. So we have discussed with you yesterday that the foreign exchange rate, basically the concept is it is the price of foreign currency in terms of domestic currency. Like if $1 we want to get, then how much domestic currency we have to pay. So domestic currency, the amount of domestic currency is the price of 1 unit of foreign currency. So just on the basis of that, we defined the foreign exchange rate is the price of foreign currency in terms of domestic currency. And it is very universal in nature. And how you can say universal in nature? Why? Because if any country where you are staying, in any country you are staying, that country is domestic country for you. So currency of that country is the domestic currency, and the rest of the world is your other currencies are the foreign currency for you. So you define like this. Fine. Now the exchange rate is determined by under the two system you understand. One system is known as fixed exchange rate system, and second one is known as market exchange rate system, which is also known as flexible exchange rate system, or it is known as floating exchange rate system. So we have seen in the last class, and we have also discussed under the market exchange fixed exchange system and market exchange rate system. Under fixed exchange rate system, you just seen that the price or exchange rate is fixed by the competent authority like RBI in India. So competent authority fixed the price of the exchange rate of foreign currency, and this decision they take on the basis of need of the economy, requirement of the economy, which suits your country. Accordingly, you are deciding it. It does not depend on the demand and supply of foreign currency. Okay, and this type of practice we continue till your economic reforms. Okay, in both the current account and capital account. So after economic reforms, we started implementing the market exchange system. And in 1992 we started, and in 94 we completely implemented current market exchange system under the current account. So all the transactions happening in the current account, they are subject to market exchange system. I will discuss here today in the BOP and everything. What is BOP, market exchange, current account, capital account. So it is that, but still we are not allowed the full capital in capital account. We are not allowed the market exchange system fully. So like API we allowed. So API is we are getting API, we are just outflowing. It is subject to the market exchange rate system, but other transactions is still subject to the official exchange rate. Clear? Now, say what is market exchange rate system? So I discussed it under the market exchange rate system. The exchange rate, the price of foreign currency is determined by the market forces. And what are these market forces? It is the demand for foreign currency and supply of foreign currency. So basically demand for foreign currency and supply of foreign currency, these two forces are going to decide the price in the market. Clear? And once price is decided by the market forces, it will, the all transaction is going on this price. Clear? You have seen that, we have also discussed with you, in any moment if you think demand for foreign currency is going, I mean it's more than the supply of foreign currency, then price of foreign currency will go up. And when supply is going to more, I mean supply of foreign currency is more than the demand, the price is going to fall. So if price of foreign currency started increasing through market mechanism, so it is known as depreciation of domestic currency. And if price of foreign currency started decreasing, it is known as appreciation of domestic currency. But if same thing is happened by the competent authorities, it is known as a devaluation of domestic currency. And next one is known as revaluation of domestic currency. So when you are writing anywhere, when you're discussing with anyone and you are saying it is a devaluation of domestic currency, so other can understand, yes, the price of foreign currency has increased, but that increased due to the competent authority. If you are saying and depreciation of domestic currency, so it means price has increased due to the market forces. Clear? Next one you are saying that is a revaluations. Revaluation means yes, price of foreign currency has declined due to the uh, competent authority. If revaluation of domestic currency, you're saying the price of foreign currency has declined, but by the competent authority. If you're saying appreciation of domestic currency, yes, price of foreign currency has declined, okay, by the market forces. Clear to all? And impacts of depreciations and appreciation is same as the devaluations and revaluation that I discussed yesterday. One more thing you understand, at the same time, the both things are happening. If suppose our domestic currency is devalued, then foreign currency is going to devalued. Clear? In the market mechanism, if you're saying that the domestic currency is depreciated, then at the same time the foreign currency appreciated. Both are happening. Suppose $1 is going to be 82 rupees, or so around 82 rupees it is there. So if $1 price is 82 rupees, it means our domestic currency depreciated, but at the same time foreign currency became appreciated. Yeah, foreign currency appreciated. And recently it becomes a controversy, the media, other things just started saying when our finance ministers made the statement, no, domestic currency is not depreciating, but foreign currency is appreciating. But she is right. But you have to say, both you are right, but domestic currency is depreciated. She made the statement, domestic currency depreciated, but she just made this statement, foreign currency is appreciated. But technically she is right, but since you are supported, your word, your attitude supported the foreign currency, you are looking from the different angle. That was the matter of concern. But as far as concept is concerned, she was right that time. Either you can say domestic currency depreciated, or you can say foreign currency appreciated. But when you are saying appreciation of foreign currency, means it shows or represents you supporting the other countries. Okay, but you don't go in this controversy. What is the fact? You have to follow this. Clear? That we have seen that. So any moment you are reading the newspaper or you are getting the informations, if you are getting the information, yes, price of foreign currency keeps increasing nowadays. If you're reading the newspaper, then you can say that our domestic currency keeps depreciating. And if you can see the price of foreign currency keeps decreasing, then you can say that now my domestic currency keeps appreciating. So this thing you understand. So last one, only one thing is left, is managed exchange rate system. Managed exchange rate system. You have few questions, you send it. Yeah, you're writing. Biswaji sent this question. Sir, why not use digital currency for important export, replacing dollar? Any possibility in future to use digital currency? But Biswajit, you understand, even the digital currency, you have to name the currency, na? Like RBI has decided to go for the digital currency. But digital currency, even RBI is going to implement, but digital currency will be in terms of rupee. Digital currency means what? There is no physical existence of the rupee, but it is the online things. You can just save, you can pay just online. It's a digital one, but uh, you have to issue in terms of rupee. You can't issue in terms of dollar. It's not our authority. Only Federal Bank can issue the dollar because that is their own currency. So even digital currency, issue of digital currency is not going to solve the problem of exchange rate. The exchange rate, you have to decide the rate, and that decision, that exchange rate price is going to decide, I mean, it will be depend on the demand and supply of foreign currency in your country. So this digital currency is not going to solve this problem. How you are going to just solve this exchange rate problem? You just penetrate the most of the countries of this world and do the trade with them. If whole world, most of the countries are started doing trade with you and is depending on you, so they need the rupee. Oh, suppose their requirement, even they're accepted the rupee, but they are knowing if I'm accepting rupee and I'm going to use this rupee in the transactions, then only they are going to accept it. Suppose I'm accepting your currency, but I'm not going to use this currency, so why I will use it? Why I will accept it? If I'm not going to use, why I will accept it? I will prefer to accept the dollar because I'm knowing I'm going to trade with any other countries, they will also accept the dollar. And if going to trade with the USA, they're also going to accept the dollar. So that is the reason demand for dollar is much more. So you have to increase the trade volume in the world, okay? And for that, you have to increase your base of industries. You have to produce quality product, innovative product. Then only you are going to penetrate in the market. And it takes around the long term to achieve this target, okay? So, but digital currency is not there, solving your issue. Next, good morning, sir. Okay, clear, Biswajit? Fine, sir. What is export on free on board basis and what is the post issue paid up equity capital? Free on board, that's I will discuss you in the later. But one point I'm telling you, post issue paid up equity capital. That is this part also we are going to use in the API. So post up issued capital, post up paid up capital means simply you understand. I am any company. I sold my equity of 10,000 crores worth, but it means 10,000 crore amount I borrowed from the public. Okay, so this 10,000 crores worth of equity or amount I borrowed through the equity is known as paid up capital, and this amount is going to decide the ownership also. If someone is holding more equity and shares, or what is the percentage of equity they are holding, they are going to claim the ownership on that. That is a paid up capital means simply you understand how much worth of equity you sold in the market and you borrowed from the public, or public contributed in your uh, business. Clear? So what is the managed exchange rate? You understand. First you write few lines, all of you. Managed exchange rate system. Right. Under this system, under this system, under this system, the foreign exchange rate, the foreign exchange rate under this system, foreign exchange rate, the foreign exchange rate under this system, foreign exchange rate is determined by the is determined by the market forces, is determined by the market forces, market forces, that is that is demand for foreign currency and supply of foreign currency, that is demand for foreign currency and supply of foreign currency, with the intervention of the with the intervention of the with the intervention of the competent authority, with the intervention of the competent authority, with the intervention of the competent authority. Clear? Right. Under this exchange rate system, this I said it just right. This exchange rate system has both the characteristics, both the characteristics, both the characteristics of of fixed exchange rate system, fixed exchange rate system, and flexible exchange rate system, and flexible exchange rate system. Clear? Fixed exchange rate system and flexible exchange rate system. Why you are saying? Because you have written first part, it is based on demand and supply of foreign currency, demand and supply of foreign currency, demand and supply of foreign currency, clear, by the market I mean that is a market forces, and also here the government or competent authority, you can say like RBI in India, is intervening in this market. So both the things are working at the same time. So it is known as a mixed exchange rate system. So technically, if you think, it is not the different exchange rate system, but it is a combination of these two. And most of the country in this world, basically they are practicing the managed exchange rate system. Even recently, few months back, when there was more inflow, of foreign currency in the country, RBI just keeps absorbing the foreign currency from the market. And that was one of the reasons that the forex reserve increased that time. Okay, where the IMF instructed and warned to the India, okay, now excessive intervention of the, in the foreign exchange market is not good because it is not reflecting actual status of the country. Okay, and recently when there is a more outflow of foreign currency from the India, there is a more outflow of foreign currency in India. What is happening? The exchange rate is shoot up. It's around 82 rupees. But if it is 82 rupees, you are just seeing that it is after the intervention of the RBI, dear. After intervention of the RBI, supplied from their own reserve to bring down the foreign exchange rate. That is one of the reasons. One side we are trying to control, but on the other hand, our reserves has declined. So we are practicing it. We are trying to manage the exchange rate. But yes, India has only limitations. We can't supply more reserves to bring back or bring down the exchange rate because we have the limitations in forex reserve. But as far as absorption is concerned, that we can do in any extent. But again, the international pressure, the things you are going to face it. Just check here how the managed exchange rate system is working. That was the reason I made you yesterday the diagram so you can better understand the whole mechanism. And it is the last diagram I am using for this in economics topic. The first time I used this diagram, this type of diagram in market mechanism. Second year, and I'm not going to use it. And all other conceptual and the discussions I will do only. So don't get panic from this diagram and say it's a price we are just discussing. Okay, and here is the origin you can take. So remember yesterday class we have discussed with you, DD is the demand curve and SS is your supply curve. Let us consider it is your, say, 60 rupees. I'm taking 60 rupees per dollar, $1 as the price, and it is your equilibrium quantity you are talking about, $1 amount. Just say, and dollar you can just write dollar you can say. So this or dollar one you can write no issue. Say E1 is equilibrium point. Suppose initially that I discussed yesterday also. E1 is equilibrium point where demand for foreign currency, intersects the supply of foreign currency, and corresponding to this E1, the equilibrium exchange rate is determined is 60 rupees per dollar. 60 rupees per dollar. And corresponding to it, the dollar amount, which is the demand also, supply also, dollar one amount. Clear? Now let us consider there is a huge inflow of foreign currency. So moment there is a huge inflow of foreign currency, then supply is going to increase. And if supply is going to increase, it is represented by rightward shift of the supply curve. Go back to the market mechanism. Okay, there I discussed with you movement along a supply curve or demand curve, and also shift of supply curve and demand curve. Okay, how supply curve is shifting, how the demand curve is shifting. So here, since there is a increase in supply of foreign currency, so supply curve will shift from SS to S1, S1. Equilibrium is going to be at U2, E2, and price is going to be, say, total amount of dollar is going to be delta dollar 2, and it is suppose it is going to be rupees 40 per dollar. The price of dollar is going to be 40 rupees. Just you try to get it here. Initial equilibrium was E1. So at E1, the forex reserve, it was continuing 60 rupees per dollar. Forex reserve, reserve not, foreign exchange rate was 60 rupees per dollar. Suppose there is an inflow of foreign currency, and that inflow of foreign currency created excess supply in the foreign exchange market. Yesterday you have learned it, okay, that is a foreign exchange rate under the market exchange rate system is decided on the basis of market forces. So if supply is more than the demand, then price of foreign currency started decreasing. Suppose you reached at the 40 rupees per dollar and equilibrium is at E2, at here, where new supply curve is intersecting demand curve, so E2 is the equilibrium point, and exchange rate has declined 40 rupees per dollar. Okay, but you are knowing that we have already discussed in the last class, yes, if exchange rate is going beyond a certain limit, then it is going to adversely affect the country, beyond not below a certain level. So when you're going below a certain level, then what will happen? Export is going to decrease, import is going to improve, which is not long term is good for the country. So if 60 is comfortable for you, so you want to bring back the 60, the foreign currency, the exchange rate from 40 to 60. How can you do that? So all excess amount of foreign currency, you start buying from the market. Who can buy? Till here, no role of the RBI. Till here, no role of the RBI. But RBI cannot see the adverse impact in the economy due to more inflow of foreign currency in the country, because maintaining the suitable exchange rate, it is the responsibility of the RBI. So now what RBI can do? RBI start buying it from the market. So when RBI start buying the foreign currency from the market, and how the RBI can buy? Because buying and selling of foreign currency we are doing with the banks. Okay, banks and other institutions, they are got license to do this business, but mainly banks are involved in buying and selling of foreign currency. So we will approaching to the banks and the RBI, we are approaching for the personal reasons, and we are buying the foreign currency from the banks. But that time RBI will approach to banks, okay, to banks, and they will start buying the foreign currency. So one side normal publics are buying it, but next the RBI started buying it. So overall demand of foreign currency will start increasing. So RBI will increase the foreign currency demand at that level. Corresponding to that, your exchange rate is going to bring back, or RBI is going to bring back the exchange rate which suits your economy. So if your 60 rupees is the suitable for your country, so RBI will increase the demand and in a such a way that the new demand curve is like D1 D1, which is going to intersect at point here at say E3, and corresponding to E3, the exchange rate you are bringing back in the country is 60 rupees per dollar. So here 60 rupees per dollar is known as managed exchange, is known as managed exchange, is known as, this time it is known as managed exchange rate, and system, and now it is known as managed exchange rate system. Okay, why manage? Because here RBI is managing, so you can see that basically you can see it's a decided, it is determined in the market by the market forces, but here demand has increased due to the interventions of the RBI. So that's the reason RBI is managing it from the back door. They are managing the foreign exchange market by increasing the demand, and then the exchange rate is determined, is known as managed exchange rate, and the system is known as managed exchange rate system. Okay, so what you're getting, basically it is determined by the market forces, but this market forces itself is managed by the RBI. This thing is happening. If you take the reverse one, suppose that, just first you think this and get it clear or not, managed exchange rate system. So you get, is it clear? Managed one is clear? Yes, today's scenario you can take the example. So here what is happening? Since RBI is buying from the market, so definitely RBI is keeping this reserve at their own reserves. Foreign currency they keep in their reserve, so forex reserve is going to increase. Take the reverse one. If suppose there is excess demand, already in the demand is much more than the supply, so price of foreign currency will shoot up. And that was the news we were getting earlier when it was so many reasons the outflow of foreign currency was more. If your government is not doing or RBI is not going to do this anything, then price may cross 90 rupees, reach to approximately 100 rupees. But finally, RBI is able to maintain around 82 rupees. How RBI has done it? So, this excess demand, one part of demand RBI is meeting through their own reserve. So, if demand is more, it keeps increasing, price may go up. But supply is very less. So, supply part, the RBI is improved from their own reserve. So, the moment supply improved to some extent, then the pressure of increase in price of foreign currency was lower, and you are able to maintain at the low level. Low level means not compared to earlier one, but low level what it can be. So you are able to manage at the lower level. So RBI doing this. So in this process, what they are practicing today, that leads to fall in reserves of the foreign currency reserves of the RBI. So compare last year forex reserve and this year, you can get the difference. Now it's declined. Okay, so this way, and most of the country are managing it. Like if you see that why China is doing, China is known as currency manipulator in the most of the countries list. Chinese economy comes under the currency manipulator. The reason is that if China becomes so honest, suppose they're saying no, I am very honest, so I will follow the 100% market mechanism. Suppose it is like this, then China is the export-led economy. So if China is export-led economy, means China are getting the more foreign currency. If honestly they are allowing the market to decide the foreign exchange rate, then can you imagine that what will be the exchange rate in the China? And if that exchange rate is going to prevail in the Chinese economy, so the pattern of trade in China is going to change, because the exports of this country is going to fall due to the appreciation of domestic currency in China, okay, and imports is going to improve. So the total pattern of trade is going to change in the Chinese economy. And China, they don't want, China, they basically don't want that. It should happen in my country. So it is the reason that whatever excess amount the Chinese economy is getting, all excess amount, China keeps absorbing from the market and trying to manage a comfortable level of foreign exchange rate, which suits the Chinese economy. And this it is the one of the reason that why USA and China is doing some cold war between these two. One of the and why USA and other countries they put Chinese economy as a currency manipulator, because what the exchange rate is showing in Chinese economy, it is not reflecting the actual trade status of China. Okay, and that is one of the reason that the Chinese economy is, put it in the so many countries the currency manipulator. But if you think from the Chinese point of view, so they are doing good things for their own economy. It may be bad for you, but it's good for the Chinese economy. They are protecting their own economy. Clear, dear? So this part is over, I think. So any doubts you have, then tell me. Check all of you, dears. If this part is over, let's move to the BOP, next part. Yeah, 3 questions you've asked. So, it has been seen that inflow of foreign currency is not equally distributed. Is not equally distributed. Investments are focused on certain sectors and specific areas. Is it adverse in nature? Subhasri, one thing you understand what you are trying to say, I'm a little bit confusing, but what I'm able to get it, you are asking, it has been seen that inflow of foreign currency is not equally distributed. You cannot expect whatever amount is coming, it should be that equally distributed. Why there is equal distribution, can you tell me? Because even your investment or capital you are getting, a particular investor is coming in those sectors that suits them, that suits them, and they are coming for the profit, making the profit. They are not coming for the charity. You understand this? So how can you expect there should be the equal distribution of the foreign currency in all the sectors? You can't. The sector like the services sector in India, where we perform better, you are getting the more investment in these sectors only. Why the investor will invest in your country, the sectors which is not competent? They will go to those economy and they will produce their own where they are performing better. That's one of the reason. You can't expect it. You have to take all the rational decisions, dear. Okay. Clear? Subhasri? Okay. Krishna, you are asking, sir, demand depends on market. How RBI can increase it? No, dear. Just let me give you one example. Let me just see other questions. Point E3 is the managed exchange. No, point E3 is the managed system where RBI pooled access foreign currency. No, dear. Yeah, you can. What you are trying to say, you are right. Ki point E3 is the managed. No, point E3 not. Point E3 not. Point E3 is the managed equilibrium. Managed equilibrium. The whole system of managing is known as the managed exchange rate system. Whole managing. See, you take this diagram in very different way. Then you can better understand. Suppose your economy is here, E1, and now your economy is observing excess supply of foreign currency. Suppose you are doing nothing, then economy can reach at E2. So what you are going to do that, you are not allowing your economy to go to E2, but meanwhile you keeps increasing demand of foreign currency and you are maintaining the same level at E3. So and you are bringing the maintaining the 60 rupees per dollar as exchange rate. So whole system of this is known as managed exchange rate system. And yes, this exchange rate, you can say managed exchange rate, the whole system. And since one of you asked, the Krishna asked, ki, sir, demand depends on market, how RBI can increase it? Very simple, dear. Very simple. You understand these things. He suppose initially demand for foreign currency, demand for dollar and supply of dollar is two are equal. Clear? Two are equal. Suppose demand is $100 and supply is also $100. These two are equal. And this corresponding to this equality, the $1 is equal to 60 rupees. Suppose 60 rupees. Suppose. Okay? Now, suppose demand remain $100 initially, but supply is not $200. Supply is there in the market, $200, and $100 only dollar in the demand. In the market, the demand is only $100. So if you leave your market, then there is excess supply, and price of dollar can come to the 40 rupees per dollar. But you don't want it should happen in my country. You want to just you are not going to allow it. So what you have to do? You have to increase additional amount of demand of dollar 100. Okay, this much additional amount. So how can you increase additional amount? So it is this much of demand is going to create by the RBI. Just RBI started buying this $100. So this much demand is created by the RBI, and already in the market is 100 demand. So total demand in the market, because RBI also buying from the market, So total demand in the market is now 200, which is equal to supply of dollar. And you are able to maintain same level of exchange rate. So this way, this works, and okay, and it is known as market exchange rate system. Clear idea? Krishna, clear? And Subhasri, you got this? I discussed. And next question you write, point E3 is the managed exchange rate system. I don't know your name, so is it clear to all of you? Okay. Fine here. And next question I am getting, sir, if RBI is buying dollars, yes, if RBI is buying dollars, so it is injecting rupee in the economy. Yes, 100% true. I discussed, you go back to the market stabilization bonds. So money supply will go up, other side, domestic money supply is going up. So if it is going to be excessive, it's going to create inflation, RBI will issue the bonds, and again you will reabsorb. RBI can issue the government securities and can absorb the extra money, and they're going to stabilize overall the country. They can do that. Okay. Just a minute. Okay, dear. So you are saying that, sir, RBI is buying dollars, so it is injecting rupees. Okay. Okay, Somali, is it clear? So RBI is not going to allow the inflation, because the all excess amount RBI can absorb by selling the government securities. They can absorb it. Okay, next is Zagannath. You are asking, sir, managed exchange rate is fixed. No, it's fixed. It's not fixed. It keeps changing, because RBI just demanding one part of that. Supply is coming in the market. Major part of demand is from the market. Only RBI is managing, but management is always the some limitations. So it keeps varying it. Okay. Next, you're asking, sir, China is manipulating foreign currency for its economic benefits. Why is not India doing the same? India is doing, dear. India is doing. But we are not export-led economy now. We are the import-based economy. So if we are facing the more demand of foreign currency in the country. We are facing more demand of foreign currency in the country. But problem is that if there is a more demand, to what extent you can supply from your reserve, because reserve itself is one of the constraint, because we can't print it the foreign dollar now. So we have to earn, since our export part is not performing. Yes, export of services is work is good, we are earning the foreign currency, but again we have a limitations, demand is much more. So to what extent we can fulfill our gap? China is the different issue. China's supply part is much more because it's export led economy. So at any amount they can purchase from the market, and that is one of the reason that if you go and see the world report, then you are getting that China is number one country having highest amount of foreign currency, highest amount of foreign currency, highest amount of foreign currency in the world. And that is one of the reason that Chinese economy Chinese economy is, okay, you understand this, Chinese economy is converting today their paper currency assets into the real assets. This is the one of the reason that, see, country like India, when they are going for international bidding, if you want to acquire some natural resources, maybe in the African countries, maybe in other countries, so we are going to bid on the basis of cost and benefit analysis. But since China has used reserve, China just want to convert from the paper asset to the real assets. So any amount they are paying that, and they are keeps acquiring the natural resources in the different world, I mean different countries in the world. So China is winning it. You understand this? So situation is something different. So that is the reason yesterday I was saying to you, I mean last class, one policy may be good for one country, but it may possibly it's not good for other country, because different economic situations is prevailing in different countries. Clear, dear? Okay, now you are asking, fine. Next question, sir. Why we cannot follow China's system? Means if E2 keeping dollar low, then why we need E3 position? Surajit, just I discussed right now. The same question you are asking. So I think you got your answer. Sir, why managed exchange rate system is known as crawling pace, Krishna? Because it's a managed one. It's you are managing one. Sometimes it is also known as a dirty exchange rate system, because it's not allowing the the proper market mechanism. You are manipulating of anything is not good for the economy. Maybe it's good for you, but not in the world, because it's not showing the actual economic status or international transactions for that particular country. Okay, you are asking, yes sir, I have read it one of the articles in newspaper where it has been said that use inflow is very skewed and in future it may harm our economy. Okay, the same things, but you have to, why you are going to allow these things happen? Okay, anything excessive is not good. Anything excessive is not good. So if you are getting it, suppose you are performing good and your export is really very good, you are earning very use foreign currency, but you have to manage it. You have to manage. If you're not managing, the pattern of trade is going to change. So you have to manage, and everything you have to do in the limit one. Okay, and just you are showing like the inflation, like exchange rate, what you're learning it above a certain level, not good, below a certain level, also not good. So you have to manage between these two. Okay, Krishna, thank you for saying the clear sum. Okay, so now it's clear to all. So I'm ending this topic here. So now use this one and try to understand the current working of the country. Read some articles day to day you are getting in the newspaper, and try to connect it. Don't read for the reading, read for the understanding. Get it, connect it, and if I prefer, if 2-3 persons staying together, so make a group, and on any topic, you say something, other will say something, and one of you, I mean the few of you, just discuss each others and interact with them. It will help you to understand and clearing your concept. Clear? Now next we are moving to your, that is a BOP, balance of payment. Acha, before going this balance payment, one things I want to just uh, I'm giving one example, just you take one example. Suppose in 2018-19, India's real GDP, India's real GDP, you calculated, say 1,000 rupee. I'm just, it's a just example. You take it is in form of example. Okay. So India's real GDP is 1,000, suppose. Any unit you can change, you can check, but 1,000 in 1819. But suppose in 2023, 2023, I want to compare India's GDP. I want to compare India's GDP in terms of dollar. You want to compare India's GDP in terms of dollar. How can you do that? How can you do that? So one of the possibility is that what is the prevailing exchange rate? On the basis of that, you convert India's GDP, which is in the rupee terms and in the dollar. Why? Because you understand one thing. If you want to compare the performance of one country with the performance of other country, so you are taking some economic indicators or economic variables, and that's showing the relative performance of the countries. Suppose like UNDP, United Nations Development Program, which is the UNDP is the under the it's UN's one. So UNDP measure the SDI, Human Development Index. So when they are going to construct or they are going to calculate the SDI value each and every country, so you are taking basically one of the indicator is the per capita GNP, gross national product of each and every countries you are taking. But problem is that per capita GNP or per capita income of one country, it's only comparable with the other country per capita income. If these two per capita income, if you are explaining or you are expressing in terms of same currency, either you bring in the same currency like dollar or euro or any other currencies or like rupee, then only you can compare these two or which one is higher, which one is lower. So one country's GDP, if it's supposed in the dollar and one country's in terms of rupee, you can't compare it. You can't compare it. So you have to convert in a single currency. So what the other nations they are doing that they are converting the GDP of different countries in terms of dollar, and after converting they are calculating the per capita income, and then they are comparing per capita income among the different countries. This is the way how the international institutions are doing this practice. Okay, so my question is that can we convert our India's GDP, which is in rupee in terms of dollar, by using the exchange rate which is prevailing in my country, which you are reading each and every day in the newspaper. Today is the 81 rupees this paisa, 82 rupees this paisa, 80 rupees this paisa. Okay, are you going to use this data or this exchange rate to convert your rupee into GDP? Suppose you are taking, then suppose in month of January, you are talking about in 2023, we are talking about the month of Jan. And which GDP or which real GDP of which year you are just going to convert? 2018-19 real GDP you want to convert in the dollar. So in January, basically Jan, you can see $1 is equal to say I'm taking rupees 25. Example, you take 25. So this 1,000 rupees, how much dollar it's going to be in month of January? So it's going to be around $40, I think. Yeah, $40. It's going to be $40. But suppose in month of Feb, the $1 is going to be around 50 rupees. $1 is going to be around 50 rupees. Then 50 rupees. Then this going to be around your $20. Suppose in month of March, next month, March, 1st Feb, suppose it is going to be around 100 rupees per dollar. So it is going to be $10. So just you can just check it. Really this is one of the best way, or really it's a rational to express your rupee GDP in terms of dollar by using the exchange rate which is prevailing in your country. Normal exchange rate, what you are getting in the newspaper. Ki today's dollar price is this, tomorrow is this. So our answer is no. No. Reason is that ki the exchange rate which is prevailing in our country in day-to-day life, okay, it's not related to purchasing power, dear. Remember, it's not related to purchasing power of goods and services. It's merely representing the demand for foreign currency and supply of foreign currency in our country. Irrespective of the purchasing power of these currencies, okay, the price are determined in the market. Any moment, if you are getting that demand is now keeps increasing, then the price will go up. Or any moment, if you are seeing that supply is improving in compared demand, then price is going to fall. So basically here price or exchange rate is determined just on the basis of demand and supply. So merely it's representing the demand and supply. So it's not reflecting the actual purchasing power. So we are not using this exchange rate to convert our GDP, real GDP, from rupees to dollar. Because if you are taking every month keeps changing, but you ask yourself, really is it true? Ki real GDP of 2018-19, this amount keeps changing every month in a particular year? So our answer is no. Then what is the solutions? How we are going to solve these problems? So all international institutions, they are following a system which is known as PPP. PPP. And this PPP is known as purchasing power parity. Purchasing power parity. Purchasing power parity. Triple P. Okay. Okay. It is known as purchasing power parity, triple P. Fine. Now, if you see the purchasing power parity, then what is happening here? Purchasing power parity, what exactly we mean by purchasing power parity? So under purchasing power parity theory, I mean these things, so you take USA, which dollar is the US's, and you take a basket of goods. It is known as basket of goods. Basket of goods and services. Goods and services. You take some goods and services here, generally demanded goods and services here. Clear? So once you take in USA this basket of goods, some goods and services are there, and think and calculate how much dollar you required, or how much dollar you need to buy this basket in USA. So suppose to buy these baskets you need $10. You need $10. Okay. Okay. So this basket of goods in USA, you need $10. Clear? $10 you need. Suppose in India, same basket of goods you take, and same basket, not that you are not going to change the basket of goods. Same basket of goods you take in India, and now you just calculate कि how much rupee you need to buy this basket. How much rupee you need to buy this basket. Suppose in India, you need to say 1000 rupee to buy this basket. Okay. So here $10 is equal to 1000. But what is the basis of equality? Basis of equality is purchasing power. Basis of equality is purchasing power. And that's the reason you are saying purchasing power parity. Parity means equality. Okay. So what you are getting that in this way, you are choosing a basket of goods which you selected some goods and services. And this basket of goods and services, if you're buying or you are buying in USA, you need $10. And same basket of goods, if you're buying in India, then you need 1000 rupees. So if you see the international platform, then you can say that how much 1000 rupee can buy in India, the same amount is purchased by the $10, or how much $10 can buy, the 1000 rupees can buy the same amount. So on the basis of purchasing power parity, you can say $10 is equal to 1000, and then on the basis of this you can say कि $1 is equal to 100 rupee. And this exchange rate is based on PPP, purchasing power parity. Okay. And this formula, you are using it when all the international institutions are using it to convert one country's GDP in the other currencies. Okay, suppose India's GDP is it in the rupee, so you are able to convert from this formula from rupee to dollar. Clear? If suppose in India, in place of India, you can take the China. So same basket you can see in the China how much Chinese currency you need it. So that much Chinese currency is going to be equal to the $10. Then you can just convert on the basis of that exchange rate Chinese GDP in Chinese currency to your dollar terms. Okay, this way we move. So this is the concept of purchasing power parity. Clear, dear? Please see that. It's a very simple one. So 1-2 lines you write yourself. देखो क्लियर है? One small concept I will do, then I will go to the BOP. Let me check your doubts. Okay, sir, has the USA any managed exchange rate system because they do not use any foreign currency? So Sumankar, actually USA is not facing any exchange rate problems. Okay, but in their country also the exchange rate is prevailing. Okay, because someone is, suppose you reach there in the terms or in keeping your money in the rupee, so yes, the conversion facility is there. Okay, now sir, YouTubers earn in terms of dollars. In which account it is count? Remedies or current account? It is a part of your invisibles account. I'm going to discuss this thing, invisibles account. You are also writing, sir, can you please speak in bilingual language? It is easy to understand. Name Moon. You understand, dear, bilingual language you are requesting to me. I do not have into problem to speak in Hindi, speak in Bengali, because I'm also from West Bengal. So I can speak in, but the problem is that in this online class, the students are from the different backgrounds. Someone is from the Darjeeling also, someone is from that part also, this part also. So I'm bound to go to bring uniformity among all the students. So I'm doing that. So this request is very difficult for me to fulfill. Okay. So please, you understand my problem, clear. But if you're staying in nearby in the Kolkata, okay. So maybe after few days, I'm coming in Kolkata to take your ATI class. So if any doubts you have, then you can come to that center and you can interact with me. That I can do. Okay, that I can do. If you're staying near Calcutta, then in between that in during that area, I mean that. Or I also given you my number. So I request you note this 20-25 days because really my schedule is very tight one. So after that, you can send me some in WhatsApp uh, as per my comfortable time. I can discuss with you. That I can do. Okay. In that time, if you any language you want, then I can explain you. Fine, dear. Now, one more things I prefer to discuss with you because you can connect with the today's condition. Then I'm going to for balance of payment things. One concept, one theory which is given by Fleming and Mundell. Fleming and not and it is basically it's written as Fleming Mundell model, or you can say interest rate differential, interest rate differential, and capital capital inflow and capital inflow and capital outflow. Yes, you can say this. Why you're saying Mundell Fleming's model? Because the relationship between the rate of interest and capital inflow and outflow, this relationship is basically explained by two economists. One is Fleming and other is the Mundell. So since two different economists explain this, so it is known as a Fleming-Mundell model. Okay. So Fleming's Mundell model. These two are explaining that. So you what this model says that. So Fleming and Mundell, these two are the different economists. They observed and after observing, okay, they given this theory. They observe it on experiment basis. They observe it and they given this relationship. And this relationship is known as interest rate differential, means difference between the interest rate of two different countries and its impact on the capital, that is a foreign capital. Either it is going to more inflow of capital in your country or it is going to outflow from your country. That is the reason we have written that interest rate differential and capital inflow and capital outflow. Clear? Now check this, what this Fleming Mundell says that or relationship is that. Let us consider I star. I is your overall rate of interest. I star is the rate of interest, and star I am putting it to differentiate the domestic rate of interest and international rate of interest. For differentiating, I put it star. So I star, I named it the international rate of interest, international rate of interest, or you can say the interest rate prevailing in other nations or interest rate prevailing in other countries. So what the rate of interest is prevailing in other countries, that rate of interest is known as international rate of interest. Clear to all? Okay, now domestic rate of interest, if you take I only, so this I is known as domestic rate of interest. Domestic rate of interest. Domestic rate of interest, I. So I is known as the domestic rate of interest and I star is known as international rate of interest. Clear? So basically this relationship says that if international rate of interest is more than domestic rate of interest, then our country, we are explaining in respect of domestic economy. So suppose international rate of interest is more than domestic rate of interest, then you are feeling that capital outflow. Capital outflow will be there. And if your international rate of interest is less than domestic rate of interest, international rate of interest, sorry, international rate of interest less than domestic means domestic rate of interest is more than the international rate of interest, then you are going to observe capital inflow. Capital inflow. This relationship is saying that. It means if rate of interest prevailing in our country, say domestic economy, then we can observe more inflow of capital. We can observe more inflow of capital. But if you are observing that international rate of interest is relatively more than the domestic rate of interest, then you can observe that the investors, they invested earlier, they started taking their money from our domestic economy and they prefer to invest in those countries. There they are getting the higher rate of interest. Simple in one reason, if you take this example, suppose you are standing here and you are the investor. Okay, say you are an international investor, you are half and domestic one, both you can say. See, if you are the rational investors, you can invest anywhere in the world. If you are investing in domestic economy and suppose the return you are getting more in domestic economy, so you prefer to invest in domestic economy. But if you are getting more return from any other country of the world, so that time you prefer to invest in other country. So how much you are going to invest in a country totally depending on the return you are getting it. Like Tata, they are also started investing in other country. Reliance, they are investing in other country also. Other country people also investing in my country. So yes, it is there. Depending on the return you can get it. Okay, so just you take, if it is the domestic country, suppose it's a domestic economy. It's a domestic economy. It is the, say, take the example of USA. Take the example of USA. Suppose in USA is offering you I star rate of interest and India is offering you I. Or better you take the India. Why you are writing domestic? India. If India is offering you I rate of interest, you are getting I in India, I star in USA. But if I is more than I star, suppose is more than I star, and you are a rational investor, so if you put your money, then you will only put your money in those states, those countries where you are getting high return. If India suppose offering you high rate of interest in compared to the USA, so not only Indian investor but investor of USA, they prefer to invest in India. So earlier suppose they invested in USA or any other country of the world, they prefer to invest in India. So money comes from rest of the world to India and you are going to face the capital inflow. You are going to. Because simple for investors, they prefer to invest in those countries. They are going to offer high return. Okay, so clear. And the next, if suppose this USA's rate of interest is more than domestic one, then investor who already invested in India, they prefer to take out money from India, okay, and they will invest in USA. So you will going to face capital outflow. So that it is known as a capital outflow you are going to face. And here is the capital inflow. Capital inflow. Simple relationship. Just check. Capital inflow or capital outflow. Capital inflow or capital outflow. Clear to all? Now, take in this way here, you are an investor and it is your own money. It is your own money. So definitely I have options of two. One is India and one is USA. So I will invest my money in that country which is going to give me the more rate of interest, more return. And why see, in practical life, if you go and see that, and what we learn in the class, okay, the policy rate, suppose you link it, policy rate of the country. Okay, and now this concept you have to use in the day-to-day life, how it's happening. Just I'm connecting this now. Look into this matter. Look in this topic. We have seen in the class, if RBI is going to increase the policy rate, say repo rate, now this is going to increase our lending rate, which is already happening in the country. And increase in lending rate is also going to increase in deposit rates, which is happening in the country. So what you're getting from this, you are getting one concept, that the policy rates is going to change all the rate of interest prevailing in the country. Okay, if it is going up, then all the rate of interest is going up. So rate of interest you are taking as a representative of all the returns also from the economy. So you just think about it, why in October 2021, after that, our country is started facing the outflow of FPI, foreign portfolio investments. Okay, I will discuss after that FDI and FPI. After BOP, I will discuss. Okay, why we are observing the outflow of FPI? Because this FPI is the investment in, FPI means if foreigners are investing in the equity and shares, that is the capital market of India, in equity and shares and the bonds and debenture derivatives. So in these assets, financial assets, if foreigners are investing, then it is known as FPI, foreign portfolio investments. Clear? So October 2021 onwards, what's happened? If you go and see that, before that also, uh, USA started implementing the contractionary monetary policy. Okay, first your initiative is taken by the federal bank, because they started facing the higher inflations, and to control inflation, they implemented the higher policy rates policy. And these higher rate policies, okay, started increasing all the rate of interest in USA. So all the returns started increasing. That high rate of return or interest rate is given the incentives to investors they invested in India, to pull the money from India and invest in USA. So they started pulling the money from India and they started investing in USA. So October 2021 onwards, India started facing the problem of outflow of capital. That's capital outflow of capital, because in USA started increasing. Since inflationary impact is the worldwide phenomena nowadays, worldwide phenomena, each and every country is facing this inflationary pressure. So other countries also started following the same policies. Like India also started implementing the contractionary monetary policy, and resulting increase in your all rate of interest and all the return. Now you're depositing in the banks, so at least you're getting on an average 7% on FD, but earlier it was just 5%. You can imagine that. So we after changing this policy, at least to some extent, we are able to moderate the outflow of capital. So you understand the policy implications, ki yes, if whole world, you have to follow the international conditions, you have to follow the international scenario also. You can't take your decision at your own only. Yes, you have to control in very restrictive way, you have to move, but international changes is going to affect your country, and accordingly you have to react, you have to take the policies. So if you are reading in the newspaper, yes, why there is a India is observing more outflow of foreign capital. So reason you can give it. And this is the one reason that you can explain, yes, due to these reasons it is happening. Now, as I discussed with you, the interest rate and investment are inversely related in very early classes, first 2 3 classes I discussed with you. If lending rate is going to increase, the investment is going to fall. If rate of interest is going to fall, then investment is going to increase. But here, relationship you are showing the foreign capital is the positive. If in your country, the higher rate of interest attract more foreign capital. What is the difference? Why it is happening? So it's happening because here you are considering the rate of interest as a return. Rate of interest as a return. But when you're talking about domestic investment by the domestic players, it is the rate of interest is the cost of investment, because most of the domestic players and domestic investors, they basically borrowing fund from the banks, and after borrowing they are investing in the market. Take the Adani group. Now today is very alert group. Alert, I mean, that's a economical alert. Economic indicator is, I mean, the business indication of the business of this Adani group is reflecting something different. They already defaulted so many, I mean, the payment of the loans. So now Adani groups having the huge amount of debt. What it's showing, it's coming in the different groups. Let us consider if it is there. So it is the only one thing what Adani group is doing is not matter for concern right now. But what I'm trying to say you, this group has invested in India, but a majority of the fund basically they borrowed from the bank and they invested in the economy. It is true. So here the rate of interest prevailing in the country is the cost for this investor, because this investor has to pay to the bank at this rate of interest, okay, this much of a rate of interest on the basis of amount they borrowed. But here you are considering the investor, those investors, they have their own money, their own money. Uska apna paisa hai, they have their own money, and they are investing in those, I mean, different countries where they're getting the high returns. So approach is something different. Okay, so any country, if they are going for stability of the economy, higher economic growth and development, so not only inflation, exchange rate, what I discussed with you, even your this rate of interest should be moderate. Rate of interest should be moderate. Why? Because if you to attract more foreign investors, if you're increasing the rate of interest in the country, you are losing the domestic investments. And to increase the domestic investment, you are decreasing the rate of interest, you are losing the foreign capital. So you have to choose a particular rate of interest which is balancing both domestic investment and the foreign capital. So this way you have to work. That is one of the reason I am telling you. Most of the policies you are implementing in the country, one side you are getting the positive benefits, but other side you are getting the adverse impact. So policy you are going to choose and you are going to implement in a very balancing way. At least that's it's giving you net effect, you are going to give you the positive one. So that way you have to choose it. Now just think about it. This part is clear? All you noted dear, written? Anything you are not getting, please tell me. Please check and tell me. Sir, previously you said that if lending rate is high, investment will decrease, but Fleming model contradicts it. That is the reason the last topic, last point I have discussed with you. It's not the contradictory result. Uh, it's a different way you are taking that. Because when you're talking about the domestic investments and rate of interest, yes, it's inverse related because here the investors borrowing money from the bank and then they are going for investment. So in this case, the rate of interest is your cost of fund. But here you are talking about those investors, they having their own money, uska apna paisa hai. So here the rate of interest is the return for them. So definitely the foreign investors, they have their own money, they want to invest in a country. Only the country is offering the high return, means high rate of interest is going to attract more investments. That is one of the issue now. That is one of the issue now. The country has to maintain the rate of interest at very moderate level so that that rate of interest can balance the domestic investment as well as international or foreign investments. Clear? I've written two. Where I've written two I star in the capital outflow. Where is two? Two I star. Where I written two I star? Capital inflow I is more than I star. Fine. When I is more than as capital inflow. Fine. When I star is more than I, so you are observing capital outflow. Yeah, we are observing capital outflow. Nothing is where two. And here I written sorry. Yes, I got it. Got it. This point. Yeah. No. Capital outflow. Yes. Sorry. Only for a star. Change it, all of you. Yeah, I star is the international. I wrongly I written there, huh? Star. It should be I and I. Both are I. And this I represents domestic one. Okay, I got it. So if international rate of interest, but several times I spoke in the in language, na. So reminder these things to change it. Yes, if I star is more than I, it means international rate of interest is more than the domestic rate of interest. Then you are going to face the capital outflow. And if your domestic rate of interest is more than the international, then you are going to face capital inflow. Clear? Mm, capital outflow. Huh. Then it's fine. Thank you, dear. Thank you. Clear? Now, this part is also over. So, purchasing power parity, different types of foreign exchange rate, and Fleming's Mundell model. This point, if you are getting it, then you can observe and you can understand why India has been losing the foreign capital. So, increasing policy rates, it was not only the requirement of controlling the inflation, it was also the requirement of controlling and balancing the outflow of capital from the country. Okay, clear hai? See, whatever you are getting this, you understand at the level so that you can use it in the day-to-day life. If you are able to use in day-to-day life, then only it is going to uh, bring you the good understanding so that you can just write and handle the current issues. Clear to all? Now, okay. Now I start the BOP. Then I will be after BOP. Then I will go FDI and this one. BOP. Balance of payment full form. Now, dear, first you please write this flowchart. Then we are going to discuss the BOP. Hmm. Please write, all of you. Check, all of you. Okay. I think all of you written this? No. Any questions? Clear. Okay. So no questions we are received till now. I mean new one, what I discussed other than this. Now come to the BOP. Just go step by step and please try to understand. BOP means balance of payment. So balance of payment is basically it records all economic transactions. So suppose I'm India, so I have a trade and other economic relationship with rest of the world. So if you take the example of India, India has relationship, economic relationship with so many countries in this world. So we do economic transactions like exporting goods and services to abroad. We are also importing goods and services from abroad. Our citizens are working abroad. Okay, they are earning the our citizens are working abroad. They are earning the income. Okay, their foreigners citizens is coming and working in India, like they are in the top managerial post. Okay, so they are also working and they are earning the income. They are getting it back to their home country. Our citizens working abroad, they are getting income and they're bringing back to the Indian economy. So also like this, it's going to happen. We give some grants, some assist, we give some transfers to other countries. We are also receiving transfers from other countries. Other than this, we are giving some external assistance to other countries, and we are also receiving external assistance from other countries. We are borrowing from other international institutions or other countries, and we are also lending to other countries. So this thing is also going on. We are investing in other countries and they are also investing in my country. Okay. So yes, there is an inflow and outflow of capital is also going on. In say NRIs, non-resident Indians, they are depositing their income in our banking system, and also they are taking it back from the system. So both the things is happening there. So what is balance of payment? I think I request you please write two lines. Okay, balance of payment. Please write two lines. Balance of payment is a systematic record of balance of payment is a systematic record of all economic transactions all economic transactions between the between the home country between the home country and rest of the world and rest of the world during a given period of time during a given period of time, that is fiscal year, that is fiscal year. Find here. So in a given fiscal year, what is the total economic transaction is happened? If you are systematically you are recording it, that is known as the balance of payment. Clear to all? Okay, continue, change the paragraph, right? Balance of payment, BOP, just you see. First you understand, then you write. So balance of payment having two different accounts and two major accounts. One is known as current account and other is known as capital account. Clear? And each account having two entry. Just see, current account has one entry is debit and other entry is the credit. So current account having one entry is credit and one is the debit. Simple logic, simple understanding. Like suppose you are using ATM card, that already I discussed with you, but again I am repeating this. You are using the ATM card. The moment you are using your ATM card and withdrawing your money, so the moment you are withdrawing the money, suppose you withdrawn money, the 5,000 from your account or 10,000 from your account, immediate you are receiving a SMS in your mobile phone. Immediate you are receiving a phone. And if you're reading the the WhatsApp, and then WhatsApp is written that in SMS, not WhatsApp, in this SMS, because basically they are sending the SMS. In SMS written that this much amount is debited from your account. Simple understanding. All you are getting the message. So debit means what? Debit means outflow of money from this particular account. Simple meaning. Outflow. Debit means outflow of money from this account. So any transactions, any economic transactions that results outflow of money, and which money you're talking about? Because international transactions is going to happen or is happening only in terms of foreign currency as far as India is concerned. Okay, so outflow of currency means outflow of foreign currency. Take the example of imports. Imports of goods. So import of goods is your debit item. Why? Because if you are importing, then you are going to pay the foreign currency. So there is an outflow of foreign currency. Okay. So if you are receiving, you are paying the foreign currency. Okay. So that transactions will come under the debit item. Clear? Now, credit item means credit means कि when in your account, suppose your parents or you are receiving your salary, the moment you're receiving the SMS, you're very the smile face and you're reading, yo, I received this much money. And surprising is what you know, it's the behavior of the individual. When you're withdrawing your money, so after withdrawal money, that money, say 10,000 you withdraw the money from your account. So 10,000 money, it is with your in your hands. Till now, just you received the money from your ATM, it is in your hand, but you are reading the news, I mean, you're reading the SMS with very sad one. Oh, this much amount is debited. A smile is not on your face. But you are receiving SMS which showing that this much amount is credited, automatically you feel the happy one. Oh, this much amount I received. So what the SMS you are getting? So the moment amount is credited or the moment you are receiving some amount in your account, so SMS you will receive that this much amount is credited. So credited means here inflow, debited means here outflow. So same thing we written as debit. DR stands for debit and CR stands for credit. Debit and credit. So you can take all the debit account, all the debited accounts you will maintain in the debit one, and all the credit you can maintain the credit. Don't go in the accounting sense. The commerce students, they are doing the debit and credit. Don't go in that. The moment you're going to get confused. Just you understand all the accounts, there are two types of transaction is going on. One is the debit, means outflow of foreign currency. One is the credit, means inflow of foreign currency. This much information we needed for the GS purpose and the other understanding for economics. Clear? Now, debit and credit both are in there. In the capital account also there is a credit and debit item. Same concept, same concept. If in current account you are receiving money, it is a part of credit of current account. If there is an outflow of money from the current account, then it is a debit item of the current account. Similarly, in the capital account, if you are receiving the money, then it is a credit item of capital account. If amount you are paying from the capital account, so it is a debit item of capital account. See, this part is clear? Okay. Now, second question come in mind, what is current account and what is debit account? Clear? What is current account and what is capital account? Sorry. What is current account and what is capital account? So, yes, I will tell you. First you write, continue that. Balance of payment is divided into two major accounts. One is current account. First you write, or second you are just, one is your current account and second is your capital account. Okay, first is current account, second is the capital account. So first you give the heading of current account. Current account you can give heading. Now, what is current account you mean? So, you know, it's just the record of economic transactions. So, you are going to put economic transactions in current account. So, suppose you assume you are an accountant in behalf of economy, behalf of all your Indian economy, behalf of economy, you are going to record all economic transactions. So suppose some economic transaction happened, you got the informations. The moment you got the information, then the moment you are opening the BOP, so there are two accounts. One is the current account, one is the capital account. So now you are going to face one of the issue, which account I should keep these transactions. Should I keep in the current account or should I put it in the capital account? Which account I should put? Okay. So the moment you are just thinking about this, then you need a criteria. You need some basis. So you need a criteria, and that criteria is going to decide in which account you should put this transaction, either in current account or in capital account. So you should know about the criteria. So what is the criteria? So only one line concept you have to develop. And what is that one line concept? If you think, or if you are getting that this economic transactions or this transaction is not related to assets or liabilities, or not changing any assets or liabilities, okay, of the country, not here the government, like fiscal policy we have done it, no, of a country, then these all economic transactions will be the part of current account. Simple in one line. So just write one line. You read in the current account, just write the all economic transactions, right? All economic transactions, all economic transactions that that all economic transactions that do not, or that is not related, ऐसे कर लो, all economic transactions which are not related, which I just write in this way, which are not related with assets or liabilities, assets or liabilities of the country, assets or liabilities of the country are the part of current account. Clear? Full stop. Write one more line. In other words, all economic transactions of current account are not changing assets or liabilities of the country, okay, during a given period of time, full stop. Just please try to get it. If you are not getting it, then might be possible the concept what I'm trying to develop with you can get some problem. So what exactly we are saying to you, I'm just discussing it. Why not I using the I? Because I also learned it. And what is the general principle, general conventions, what actually how economy performing, that just I'm informing you, I'm discussing with you. Okay, so you understand this, what you are saying. So you are saying the current account is related to those economic transactions which are not changing the assets or liabilities of the country. These are not changing the assets and liabilities of the country. You remember assets I discussed with you. If you are claiming on something, if your claims are there, then it is a part of the assets. And if it is with you but it is others' claim, then it is a liability for you. These two concepts already I developed with you. Okay, now you get other things, you can get it here. Suppose I am taking this as a central government, I mean the not government, as a economy, Indian economy, and you all are the rest of the world. Then I recorded exports of goods and services is the part of your current account. Suppose current account. So you have to think about really exports of goods and services or import of goods and services really changing any assets or liabilities of the country or not. But you have to analyze after completion of the transactions. Just say, suppose I exported to you. something, maybe anything, I exported to you, you paid me, I sold some goods and services to you, you paid me, I received the payment. Transaction is over. Now, after these transactions, you are going to claim to me? No. I am going to claim to you? No. So, no claim has generated from either side. If claim is generated from your side to me, it is liability for me. If I am going to claim to you, then it is the assets for me. So, if you see the transactions which are included in the current year, a current account, it is not going to change the assets or liabilities of the country. Whole country you have to take. Take other things like the capital account. When you can say capital account, or when you can put some transactions under the capital account, so you have to think about it. The economic transactions, if that economic transaction is going to change the assets or liabilities of the country, assets or liabilities of the country, they're going to change, then we can say capital account. It's a part of capital account. Take one simple example. So what you can say, the capital account includes all economic transactions. All economic transactions. They are related to assets or liabilities of the country. So after transaction, you have to check कि really these transactions anyhow it's related to assets or liabilities of the country or not. If yes, then part of capital account. If no, then part of your current account. So just you take the example, I borrowed some amount. I borrowed some amount from any international institutions or maybe in any country or any private the banks in outside of the country. I borrowed it. I received the money. So borrowing from rest of the world is the part of your credit items because I'm receiving the money. But this much amount, the amount I borrowed, this much amount of debit or this much amount of liability, not debit, this much of amount of liability has created. If this much of liability has created, then you understand about this. This much liability has created, you understand about this, कि yes, कि this receiving of amount has created the liabilities. So it is a part of your capital account. Suppose I purchase the USA government bond. I purchased the USA government bond. I paid this amount. So it is an outflow foreign currency at this moment. But I started claiming that much amount to the US government. Yeah, I lended you through your bond. So again, this outflow will come under the capital account. Okay, like foreign investors, they are investing in India. After investment, they started claiming these assets, this capital is mine. If you are investing abroad, any other car like Jaguar, which is claimed by the Tata, it's a Tata's property. You are claiming that. So your capital inflow and capital outflow is a part of your capital account. So just basic concept you have to develop that any economic transactions, if any economic transaction, if it is related to assets or liabilities, then it is a part of your capital account. It's not related, then it's part of your current account. So in current account, you have to write one more line, or you can write one more line. The same things, any transactions, any economic transactions, if it is related with assets or liabilities, it's not related to assets or liabilities of the country, not government, of the overall country, not related with assets or liabilities of the country, then it is a part of current account. Simply it is a part of current account. So clear the current account here. Now you write one more line, change the para, you write current account has two sub accounts. Current account has two sub accounts. One is BOT, balance of trade, and second is Invisibles account. Okay. Remember, in invisibles account, in the bracket, I have written net, NET net. Yeah, there is a reason why we are writing net. Because if you go and see the BOP, balance of payment data of the government of the country, then it's given as net, NET. Okay. So you write invisibles account. The first is BOT, next is invisibles account. So you can also say the current account is divided into two account. One is the BOT and one is the invisibles account. Write first BOT, give the heading of BOT, balance of trade. Right, BOT, balance of trade. Right. Balance of trade, balance of trade, balance of trade includes, balance of trade includes exports, exports of the goods, includes exports of the goods and imports of the goods, exports of the goods and imports of the goods during a given period of time, during a given period of time. Just you can see BOT, we have taken only two entry. One is known as exports of goods and second is imports of goods. Exports of goods is the credit item, but imports of goods is a debit item. Because if you are exporting of goods, you are receiving the foreign currency, and if you are importing the goods, it means there is a outflow of currency. Okay, so it is a debit item. Clear to all? Clear? Right, full stop, right? BOT of India, balance of trade of India, balance of trade of India has been has been has been has been in deficit, in deficit, has been in deficit, has been in deficit because imports of goods, because imports of goods is more than exports of goods. Imports of goods is more than exports of goods. Imports of goods is more than exports of goods. Full stop, right? Recently in July 2020, recently in July 2020, July 2020, BOT observed surplus. 2020 BOT observed surplus. BOT observed surplus after around 18 years. After around 18 years. After around 18 years. Okay. But overall fiscal year 2021, overall fiscal year 2021 remains deficit. Remained deficit. Remain in deficit. Remain in deficit. Clear? Full stop, right? BOT, balance of trade, is also known as, BOT is also known as visible account, because other is known as the invisible. So you can write it is also known as visible account, or merchandise account, visible account or merchandise account. So three name you can just say: balance of trade you can say, merchandise account you can say, or visible account you can say about BOT. And in India, even before economic reforms you take, after economic reforms period you take, BOT remained as a negative. Okay, because we are importing huge amount from rest of the world in compared to importing the goods in compared to what we are exporting goods to the rest of the world. And the highest BOT, balance of trade deficit, it is with China. It is with the China, yes. Trade deficit very huge with the China because we are importing huge amount of goods from the Chinese economy or from the China. Clear? Clear, dear? So let's stop today and we are meeting after the break. Okay. Thank you, everyone.